and welcome to a very special edition of Market Masters, where the brains trust of JPMorgan is joining us ahead of their India Summit. My guests are Sajjid Chinoy, the Chief India Economist, Kaustubh Kulkarni, the Senior India Officer and Vice Chair, Asia Pac, and Sanjay Mookim, the Strategist and Head of Equity Research. I hope I got your designations right. Gentlemen, what a great day to have you in our studio at that. Sajjid, this is the unexpected first question, but it's just lit up all markets in India, the JPM bond index. I don't know if you all know the numbers better than the rest of the market. How much money are we really talking in terms of what can come because of passive funds?
That's like, given the amount of assets that track this index and given India's 10% weight, I think from this index, the direct flow will be somewhere in the range of $20 to $25 billion starting from next June over a 10-month period. And then, of course, there'll be some catalytic flows that amount because of this. But I think the larger issue is not so much about the quantum of money. It's about two other things. One is to just have some more heterogeneity in the investor space in the bond market. The more heterogeneity you have, the better price discovery you will have in both directions.
No, but passivity, I mean, you just...
That was my second point, that it's really passive flows. And I think the bond money and debt money now has become, attracts a lot of indices. And so if India has a 10% weight, what you should expect is not too much volatility around that. In the good times, investors may take 10 to 12. If there are adverse shocks, they may go down to 8. So I think that's the part that we should recognize, that this is passive money that's here for the long term, and therefore is in a way India tapping into the global pool of savings to finance its current account deficit.
Oh, absolutely. We've had enough experts speaking to us, and the expectation is that once JPM index bites the bullet, as it were, the Bloomberg, Barclays, the FTSE Russell will also include. So the numbers that are doing the rounds is probably 40 to 50 billion, only passive. And then there are, of course, actives who want to, take advantage. So, that question to you, Sanjay, how would you look at equity markets if there is this kind of money? Do you think now leveraged companies would be preferred because, it's going to be cheaper to borrow? Would you think banks become a little more attractive? I know you have not rewritten your strategy report, but what may be the likely changes?
Well, I think, and Sajjid will be better to comment on the currency and rates impact.
Yes,
but look, this will be to prima facie be supportive of the INR, so you will not be worried about terrible depreciation for at least the next foreseeable future. Will Indian bond yields go down too much? We'll see, I guess. But the argument logically, Latha, will be that a lower interest rate would be supportive of valuations of companies because you're back in the DCF goes down and so on. My only nervousness is that we are not pricing off the 7.2 in the Indian equity market anyway, right? The equity market is already way ahead of all these inclusions in terms of using a lower cost of capital in its valuations for longer term growth. I personally don't expect any decoupling of India's equities to the global equity sentiment. And that's a theme that we've been writing about for a while, that India's great in the long term, all the structural growth is real, but in the short term, the market does move in line with global sentiment. And that's why, a month ago, we wrote the note that the market still looks very toppish.
No, I take your point entirely on that, but immediately you would think that banks become more attractive. Mark-to-market gains.
Potentially. But I think the equity market tends to look through these mark-to-market gains. I mean, even when you have losses, you don't go and sell some of these stocks anyway. So yes, there will be support to earnings accounting-wise, but I don't think that will be a fundamental reason. Banks anyway look great to us because earnings growth is strong, and it's probably the only sector in the market where valuations are acceptable. Yeah. So the core argument still is very strong.
Very strong for banks.
Yeah.
I'm just coming to you in a minute, Kaustubh, because we just want to get through with this big change that is on us. Sajjid, there will be a big inflow of funds starting from June, and according to bond market experts, even ahead of it, active funds may come in.
Right.
So, how should we approach the Indian rupee?
Yes.
On the one hand, there is the strength in the US dollar. The dollar index is at 105, and the US 10-year yield at 4.5. I mean, why would an exporter want to sell and come when he can get 4.5 for $1? So, how should one approach the rupee?
Yes.
And will the RBI have now a big problem? They will not want a rupee appreciation because they may become uncompetitive.
That's we're at the 10th anniversary of the taper tantrum, right? What is the biggest lesson we learned over the last 10 years? Buffers matter. right? We had $280 billion of reserves then, almost $700 billion at the beginning of last year. I think the RBI strategy, in my view, should not change, which is that when you do have large balance of payment surpluses, you buy these buffers, you buy the dollars up, because these reserves are not earned reserves, they're borrowed reserves. There are corresponding liabilities in the economy which could exit the day after. So I think we have to think through the general equilibrium impact over here, that if these flows do come, I'd expect the central bank will buy those dollars, will not allow more than a small amount of appreciation. And there is also a corresponding impact on the bond market that we're not fully internalizing, because when you do buy those dollars, you are generating rupee liquidity and sterilizing that, which is what the RBI will want to do if you're worried about inflation risk, will entail the RBI selling bonds. So when you think about the net impact on the bond market, essentially foreigners will be buying bonds, but if the RBI is sterilizing those dollar purchases, that to some extent at least, these will be partially offset by the central bank selling bonds. So this is clearly positive from a medium-term passive global savings perspective, but the impact on prices, whether it's bond yields or the rupee, are a little bit more nuanced given the central bank's reaction function.
In OMO sales this fiscal itself or in 2023 itself? Because I thought at this moment, if the dollar flow is big,
yes,
RBI will buy the dollars and they're very happy to tighten liquidity,
yes,
because that is anyway their position. You actually see them selling bonds.
I'm not saying this year. I'm saying that when these flows come over the next year, I think what the RBI has done very well is ensure that liquidity is consistent with their rate policy. If US rates are going to be high for long and Indian rates are going to remain at current levels, you won't want liquidity to run ahead of where yields are. So next year, if you do have a large BOP surplus because of this, it will be understandable why the central bank will want to sterilize these flows.
Right.
One way of sterilizing it, there are many ways to sterilize, is to sell bonds and soak up that rupee liquidity.
I guess they're more independent in selling bonds rather than selling dollars, because that will depend on global matters. But Kaustubh, you have to tell me, who's your audience in the summit? Are you seeing some last minute rush of FII debt funds wanting to come in? More generally, who are the funds coming in? I also wanted to know if there are more India dedicated funds and not just funds coming through GEM.
Okay, so I think the way we look at it, there are almost 400 investors attending your conference. I think it's almost 50% more than what we had in the previous year. So that's the first sign. I think of those 400 investors, almost 300 on the equity side and about 100 on the debt side. We have about 75 companies which represent almost about 1.2 trillion of the market cap in India. And I think from those 75 companies, there are a number of corporates and others who are also attending a number of sessions and high quality content we have planned. So we have 250 attendees from the corporate side who are coming in. So it's being done at a very substantially larger scale. We would like to welcome more, but I think ironically we had to stop registrations because I think we just couldn't accommodate anything more.
So those who came after the
no, even before that actually, even before that. So
okay.
we've just done our full capacity given I think the response that we have received both from companies and from investors who really want to be a part of it. And I guess the reason
but you would agree that there is money coming not just through GEM funds,
yes,
but now more India dedicated, you would say?
I think not yet, because generally if you're a large global pool, there is benefit in size. So if you're managing 10, 20, $30 billion of emerging market funds, it is easier for you and more flexible for the fund manager to allocate accordingly rather than just doing an India dedicated. Having said that, there are clearly India dedicated funds which have been targeted and marketed globally. But the relative size of those is still sub 10 billion. Okay. And we are getting good representation from both sides of investors.
Okay. Sanjay, now to come, when all this money comes and this kind of interest is shown, do you think that Indian equities, I mean, I know you said that you're watchful of valuations, but will we trade at higher valuations than, say, the long-term 20-year average?
We already are there, Latha, unfortunately.
Okay.
And if we weren't,
I thought we are still south of the 2007-2008 valuation.
Possibly. So if you exclude the extraordinary periods of valuations post DFC and the COVID, then we are close to all-time highs on the Nifty already. So if we weren't, then you'd be a little bit more comfortable. But making an investment case saying that the multiple will go higher is always weaker in argument, right? You always want to buy the earnings growth and the compounding that the economy will generate, rather than to base your thesis on saying, I think other people will buy at higher multiples, right? Okay. So the first part, we are confident. You will get decent earnings growth, and actually we've written research that earnings growth in the next few years will be better than the pre-COVID period and so on. But is the thesis based on higher multiples? I wouldn't go down that path.
Let me come to one of the sub-segments that have done extremely well. Mid-cap PSU banks have done very well, and we just tend to get carried away with the mid-cap PSU banks. Even the small-cap private sector banks, some of them have done very well. So you began by saying that anyway you are very happy with banks, and at the current juncture they are on your buy list. Would you go down the queue?
Well, I'll take the opportunity to pat ourselves on the back, because a few months ago we write these tactical notes on what sectors look interesting for short-term trades. We did pick out PSU banks 4 months ago in one of our research pieces, and the thesis for that, Latha, was that we were starting to see again for the smaller banks earnings upgrades. And the sector, if you remember, around the first quarter had underperformed the market. So it was a great opportunity to look at sectors or stocks which hadn't done well for a variety of reasons, but were delivering earnings better than expectations and were driving upgrades. I think that's what's kicked in, where it's caught the market by surprise. We've seen banks do well for the last 2 years, but you had this another meaning cycle which has lasted for a while. We do think that the overall loan growth will slow. Right, and this is tying into the lack of liquidity in the system. Deposits are a constraint, and margins are coming in under pressure. So the sort of growth that you've got from banks in the last couple of years will slow. But if you look at a combination of growth versus value, the entire financial set is the only thing that makes sense in India. I mean, logically at the moment.
Okay, I'm not done with the sub-segments. There is the other two superb segments, not two, actually three: railways, defense, and power. And many of them are overwhelmingly public sector. So those questions to my experts after a very quick break. Welcome back to this very special edition of Market Masters, where I have been speaking with the Brains Trust of JPMorgan ahead of their India conference. I've been speaking with Sanjay Mookim, the strategist, head of India Equity Research, Sajjid Chinoy, chief India economist, and Kaustubh Kulkarni, the senior country officer India and vice chair of Asia Pacific region. Gentlemen, thank you for your patience. Thank you for waiting by. Sanjay, now to that unfinished argument. Before the break, you spoke about PSU banks. Now, PSU as a theme, defense, railways and power have been doing exceptionally well. More to go?
Operationally, possibly. Right? So if you look at the power sector, we've liked it for a while because you've seen a significant improvement in the cash flow dynamics of power companies, where all the reforms have finally started to have effect. Receivables for, let's say, generators have fallen significantly YOY, and you're seeing surprising demand growth, which was actually forgotten in India. For many years, we assumed that demand growth will remain lackluster, and now you're starting to get double-digit demand growth. So the system is tightening quickly. You should therefore see a spurt of capex. So everything's sort of falling in place. The challenge you have is that which company benefits because of this dynamic, because many are regulated return, they don't really have upside to higher prices or most of it.
And the DISCOM health is still a question mark, you would think? I mean, are they paying their bills, or will they always pay their bills?
The way I understand it is that this is semi-permanent, if not fully permanent, and it will be very difficult for DISCOMs to go back to the old ways and stop payments and delay payments and so on. We've seen this happen manywhere. In fact, one of the smaller states I visited recently, met the power secretary, they've reported a profit. The DISCOM has reported a profit in many years. Okay, and so if this stays, I think the entire health of the power sector should structurally improve.
So it is in your buy list?
Yes, it is a sector that we have liked from a reform momentum point of view. The others are more capex driven, right? It is driven by momentum of spending, especially from the central government. And there you will have to analyze year on year what is the continued momentum. Do they have the money in the budget to continue the pace at which they have grown in the last 2 years? Our bias is to say that will slow here.
Fair point. But the entire mid-cap space, I want to come to you. But before that, let me get the macro clear. Sajjid, how is the India growth story shaping up? 7.8 first quarter growth was like, 7.5% below the Q4. Now, Q1 is always lower than Q4, but 7.5% was quite a bit. So clearly the pace of growth is not as superb as it was pre-COVID. But on the other hand, now the recent data from the US, the Fed has actually doubled the pace from 1%, now they expect a 2% GDP. So all told, how is the growth story looking this year and the year now.
Right. So I would look at the drivers of growth, Latha, and what you're seeing encouragingly domestically is there are at least three drivers that have combined together in the last year. One, of course, is the central government's unrelenting capex push, which has a big impact on growth in the first 6 months because it's been complemented by state capex, which was weak last year, also joining the party. Secondly has been, and we saw this, that the health of the financial system is now the best in a decade, and you're seeing this in higher credit growth. And the third is the residential real estate cycle, dormant for a decade, is picking up. So all these three things have combined and they're contributing to growth. Having said that, a lot of our growth over the last 3 years has come from the export angle. Right? So exports are 24-25% of GDP. Their contribution to growth has been 40% of GDP in some years. The US resilience is very encouraging, but the fact is that that's US exceptionalism because other parts of the world have been far more disappointing, whether it's China or Europe. So we have to brace for the fact that the export tailwinds that we got for much of the last 3 years, first it was goods, then it was services, will begin to fade over the next 12-18 months. And when they do fade, it will be incumbent on the domestic demand drivers to pick up the baton. Now, the public sector is doing its part. So what I'm looking at in the next 12-8 months is what happens to private consumption and private capex. On private consumption, so far it's been the upper end that's been firing. At what point does the lower end, does consumption broaden out to the lower end? And secondly, at what point does public capex translate into more robust and broad-based private capex? 2 risks to monitor, 3 risks to monitor. One is the fiscal impulse in the first 6 months is very strong. You can't get that impulse in the next 6 months. That will have some impact. But 2 more fundamental risks are crude prices. We were in a sweet spot in the first 6 months of the year. Crude is now at $93 a barrel. That will have some impact on margins and earnings and growth. And the second is the monsoon. Fingers crossed, good news. September has been stronger, but we have to. El Nino is just getting started. So I would look at the monsoon and crude closely and see what kind of headwinds they create.
Okay. We have now more money in the kitty for, fiscal transfers when the bond money comes. But okay, that's next year. One of the factors that you didn't mention, and I guess that's now taken for granted, Kaustubh, the China+1 story. I mean, we know that Apple has made a big success of it and more could come. There could be more apples to follow. Other apples will follow. So is this a buzz you hear since you are the Vice Chair Asia Pac? Are we seen as a fairly big alternative and you may be in the thick of many deals?
So I would say specifically from India, it is still relatively early. And we think of China+1, in fact our team calls it as globalization 2.0 rather than anything else. But just to give you one stat, between 2019 and 2022, of the US imports from Asia, China contribution has come down by 15 points and India has picked up 1.5 of that 15, which means the remaining 13.5 has been picked by other parts of Asia, including Southeast Asia, Korea and others. So the China+1 narrative is actually interesting for 2 reasons. One, number of existing Indian businesses which were already in the exports area, including let's say pharmaceuticals, chemicals, agrochemicals, engineering goods, all of those are seeing substantial growth and traction. So a reasonable amount of investments are actually being done and they're benefiting because of customers looking to shift away from their existing sources and supply chains in China. But the larger question is whether the existing large capacity which is operating in China and Taiwan also looks for alternatives outside of China and Taiwan. That, as far as India is concerned, is still relatively early.
Okay, they're not dismantling, it's incremental money that's looking for new homes. And we are high up on the list of possible options. Yes. Okay, well, Sanjay, now to come to what's happening in the markets. I mean, the Nifty is 9.5% year-to-date higher. The mid-cap and the small-cap are 27 to 28% higher year-to-date. Right. PSU index 35%, but we discuss PSUs. Now, this mid-cap, would you still prefer to have more mid-caps in your list than large caps? Your comment on the rally and what would be your, what would your list look like?
Okay, since I took credit for something we got right, this is something we actually got wrong.
Okay.
Right. Early in the year, we argued that mid-caps already were starting to look very stretched on valuations, and our concern back then, Latha, was liquidity risks. Because in all of these rallies, the one variable that everybody tends to forget every time is liquidity. And mid-cap liquidity is always one way. You can buy the thing up, but try selling it on the way down. It's very, very difficult. Now, what has catalyzed this, and I'm going to give you a very strange answer. If you look at the start of the mid-cap outperformance to large caps, or whether it is the internet companies or consumer discretionary or NBFCs, it's all started on the 13th of March 2023 when the Fed injected money in the system for SVB bailout. Global growth stocks, growth has a style globally, took a leg up on the day that the money was injected, right? Now, which we did not anticipate, and it has played out exactly as you expect, that anything with the prospect of growth has done well post that injection. What has confounded us is that the Fed has reversed, and balance sheets for central banks are now contracting, but Indian mid-caps have found a life of their own, right? So you've seen...
And there is also a lot of money flowing into mid-cap funds, mutual funds, domestic money.
Probably that flow dynamic which has given further legs to the mid-cap basket, but if you look at MSCI World Growth, it is rolling down. If you look at the NASDAQ, if you look at AI...
That's a red flag for our mid-caps.
It is. So to your question, would I be now allocating more money to mid-caps? Extremely carefully, if at all.
Okay. But your preference would be large cap. What would be the top?
So we've said very clearly, investor portfolios should move to larger cap value stroke quality plays. We've been saying banks make a lot of sense.
Okay, banks first and then whatever. Consumer discretionaries, construction companies, capex.
So discretionary is the growthy aspect to it. So we prefer staples over discretionary. Now, yes, we have written notes as well saying that the festive season looks stronger than expected. And if that actually plays out, then there are some discretionary baskets that might do well tactically. But from a style point of view, I'd rather not be in the growth basket. Therefore, staples make sense. Two-wheelers, for a recovery point of view, we like I said, power. We like the real estate space where, again, you're starting to see continued momentum despite the mortgage rate increases. So there are genuine bottom-up opportunities still that we like. But as a style, stay away from the hyper-growth or the more hope trade stocks in the market.
Okay, I'm being warned, and I may even lose my job, but I have to ask you this last question very quickly. The savings, household savings becoming 5.1, it's a 47-year low, and household indebtedness increasing. Just interpret it, extrapolate it for the macro.
So firstly, it's one small sliver. We have to look at the whole pie. What you're seeing is gross savings has not fallen, but household financial liabilities has gone up, which should not be surprising given where credit growth has gone largely to retail and to households over the last 18 months as banks have become less risk averse. But if you step back and look at the economy-wide perspective, we don't have the detailed data, but you can back out what's happening because the current account deficit is nothing but the investment savings gap. We know the current account deficit. We know the public sector's investment saving gap because we know the fiscal deficit. If you back it, and we know investment for the economy. If you back it all out, the early read is for FY23 gross private savings perhaps are down by 1.2% of GDP. This is not surprising because when you get so much exuberance in the banking system, leverage does pick up. But we have to watch this closely because if you're seeing consumption being financed by running down of household savings, that is something that we'll have to keep a very close eye on.
Okay, because we need that fund growth. Out of time, but not out of questions, through the summit, we will try and catch you all and other experts from JPMorgan and other guests who come there for more discussions on the Indian economy. Thank you very much, Sajjid, Kaustubh and Sanjay, and I hope you have a great conference out there. Well, that's a wrap on this very special segment. Thank you very much for watching.